Next, let's switch gears from semiconductors to vacations. Yes, we're talking about Airbnb. If you own Airbnb stock, you might wish you were on vacation, because the stock's performance has been underwhelming. It is up only about 4% over the past year, and is down roughly 7% year to date, even as the broader market has posted solid gains. But here's what many investors overlook. Airbnb is still growing quietly. Revenue has increased for 4 straight years. In its most recent quarter, the company delivered 13% year-over-year growth, its best result in more than a year. So why is the stock struggling? First, international travel is facing headwinds from trade tensions and economic uncertainty. Second, more companies are calling employees back to the office, reducing remote work flexibility. And third, if the US economy slows, discretionary spending like travel is often the first thing people cut. Competition is also heating up. Major hotel chains are moving into Airbnb's territory by offering standalone rentals with loyalty perks. But before you write Airbnb off, consider the positives. The company is a cash flow powerhouse, generating $4.3 billion in free cash flow over the past year. Management clearly believes the stock is undervalued, approving a massive $6 billion share buyback program. Valuation-wise, Airbnb trades at about 25 times forward earnings, which is near a historical low for the company. There are risks, but there is also clear value, and Cathie Wood seems to believe the market is underestimating Airbnb's long-term staying power. Finally, let's talk about a name fresh off the IPO runway, Figma. If you're in the design world, you already know it. Figma makes cloud-based design tools that allow teams to collaborate on websites, apps, and digital products. Think of it as Google Docs, but for design. Figma went public just 2 months ago at $33 per share. Demand was explosive, with the IPO oversubscribed by 40 times. On its second day of trading, the stock surged to $143, more than 4 times its IPO price in less than 2 days. But the hype didn't last. Since then, the stock has dropped more than 60% from its peak. And once again, Cathie Wood stepped in to buy the dip. ARK Invest participated in the IPO and has been adding shares as the stock cooled off. Looking at the business itself, Figma's growth is impressive. Revenue climbed 48% last year. This year, growth has slowed slightly, but still came in at 46% and 41% year-over-year in the first 2 quarters. Yes, the valuation looks expensive compared to AMD or Airbnb, but disruptive growth companies rarely look cheap. The post-IPO pullback may actually offer a long-term entry point for Cathie Wood. Figma checks all the right boxes: innovation, strong growth, and the potential to redefine how teams design and collaborate. So what do we make of these 3 buys, AMD, Airbnb, and Figma? On the surface, they're completely different: semiconductors, vacation rentals, and design software. But they're connected by one core theme: disruption. Cathie Wood doesn't invest in the present. She invests in the future. She's willing to accept short-term volatility in exchange for long-term transformational potential. Love her or hate her, that strategy has delivered massive wins over time. Do these stocks belong in your portfolio? That's up to you. But one thing is certain: when Cathie Wood goes bargain hunting, the market pays attention. If you enjoyed this breakdown, please like the video, share it with someone who follows the market, and subscribe to the Wealth Wisdom so you don't miss future updates. Thanks for watching. Stay curious, and I'll see you in the next one. Cathie Wood is at it again, the star fund manager behind ARK Invest, famous for spotting disruptive innovation plays before they become household names, has been making some bold moves. And guess what? She's been bargain hunting. That's right, she just went shopping for 3 dynamic stocks that she believes have serious long-term potential. Now, whether you love her or you're skeptical of her moonshot investing style, you can't deny this. When Cathie Wood makes a move, Wall Street pays attention. And today, we're breaking down exactly what she bought, why she bought it, and what it could mean for investors like you and me. Welcome to the Wealth Wisdom. If you're new here, we break down the biggest stories in tech, finance, and innovation, along with stock market news and analysis, in a way that's fun, easy to follow, and worth your time. Before we dive in, please take a second to hit the like button, share this video with your friends, and subscribe to the channel. Please help this video reach at least 500 likes. It really helps support the channel and allows us to keep bringing you the latest market insights. Thank you. Disclaimer: this video is for informational and educational purposes only. It is not financial advice, and I am not a financial advisor. Always do your own research before making any investment decisions. Now, Cathie Wood's biggest fund, the ARK Innovation ETF, is up a jaw-dropping 77% over the past year. That's not just a rebound. That's a full-on rocket ship. Growth stocks, especially in the tech and innovation space, are back in style. And here's the kicker. On Tuesday, Cathie and her team weren't just nibbling around the edges. They were scooping up shares, adding significantly to positions in 3 stocks. And these aren't random picks. Each one tells us something about where she thinks the future is headed. Let's break them down one by one, starting with a name you definitely know. First up, Advanced Micro Devices, ticker symbol AMD. If you've been following the stock market for a while, you know AMD is like that roller coaster you can't resist. It's thrilling, but it can be bumpy. The company makes CPUs, GPUs, and other high-performance microprocessors. While Nvidia has been the poster child of the AI chip boom, AMD is positioning itself as the scrappy challenger that refuses to be counted out. Since hitting rock bottom back in April, AMD shares have more than doubled. But here's the surprising twist. Over the past year, the stock is only up about 5%. That's barely a pulse compared to the broader market. This tells us one thing: volatility is the name of the game with AMD. So why does Cathie Wood like it right now? Simple. Artificial intelligence. Data centers around the world are scrambling for the computing power needed to fuel AI. And while Nvidia may be hogging the spotlight, there's plenty of room for a second heavyweight. AMD's Instinct GPUs are gaining traction, and with AI demand exploding, they don't need to be number one to win big. Now, let's be honest about the risks. AMD's stock has slipped about 15% from its recent highs. Growth is still strong, but it's slowing slightly. Revenue jumped 30% in the last quarter, but management is guiding for around 28% growth next quarter. That's still solid, but Wall Street prefers acceleration, not deceleration. Some analysts aren't thrilled. One recently downgraded the stock, citing high valuation and weaker margins. AMD currently trades at about 27 times forward earnings. That's not outrageous for a growth stock, but it's not cheap either. Then there's geopolitics. Trade tensions and restrictions on selling GPUs into China remain a real headwind. But on the bright side, AMD's gaming and client segments are roaring back, with sales up 69% last quarter. So yes, AMD is a roller coaster, but it's exactly the kind of ride Cathie Wood loves: risky, innovative, and potentially transformational. If you're enjoying these insights and finding value in this breakdown, please like the video and share it with others. It really helps the channel.